And to make it a little easy, I'll just start with an example. Let's say Balkrishna Industries, which is a tire maker. We would, when we analyze, split it into two entities, Finco and Opco. Balkrishna Finco would have all the fixed assets, plant, machinery, and all, and working capital would be assigned to it. Opco would be assigned the revenue EBITDA, from which a operating lease cost would be deemed to pay, and working capital financing cost would be deemed to pay to the Finco, and tax paid to the government. Then, what will be left with Opco would be excess return on invested capital. So free cash flow associated with excess ROIC is what is left in OpCo. Present value of such cash flows is basically the present value of excess ROIC. On the other hand, FinCo is nothing but dumb capital, invested capital, because here by design, cost of capital is equated to return on capital. So going by first principles, the value of this is merely the value of invested capital because growth is immaterial. So by this construct, what we've done beautifully is it's simple, no scientific, invention, but simply application of our philosophy or use of financial theory to be in sync with our investment philosophy. So we break down, as you'll see in the bottom box, enterprise value of the company into its subcomponents, invested capital plus value of excess return on invested capital, FinCo and OpCo. You'll be amazed how different these could be for companies even in the same industry. Balkrishna Industry, which is an efficient user of capital, 85% of the value is in OpCo or excess ROIC. Only 15% is in FinCo. So when you give $15, they generate 85 in excess ROIC. For $1, they generate $6 extra. And when you're investing 85% in excess ROIC value. Whereas Apollo Tires, which has not had such a good track record of capital allocation, there the ratio is the other way around. 90% of the value is stuck in low value FinCo. Only 10% is in OpCo. That means for every dollar, they're only generating 10 paisa or 10 cents of excess value. When you rearrange these terms, you get importantly the bottom equation, which is price to excess ROIC multiple. So instead of looking at price to earnings multiple, we focus on price to excess ROIC multiple, which equals the value of OpCo divided by the free cash flow of OpCo, which is basically excess ROIC cash flow. And this is the multiple we use to compare across companies rather than comparing P multiples. For Apollo, as an example, the P multiple is 10 to 15 times compared to Balkrishna, which is 25 to 30 times. But if you were to look at this excess ROIC multiple, the excess ROIC multiple would be hundreds of times for Apollo as against 35 times for Balkrishna, which by the way is also the multiple of Sensex is also 35 times on FY23. So P multiple of Sensex on FY23 is 21 times, but the excess ROIC multiple or the OpCo multiple is 34 times, right? So that is what we would use rather than P multiple. The excess ROIC multiple is what we use in making our comparable comparisons. So DCF value, as we discussed, and excess ROIC multiple is what we use as metrics.